Welcome to today's explainer. We are jumping right in because we've got a fascinating and honestly super important topic to unpack today. We're looking at a direct mathematical link that usually gets completely buried in dense financial jargon, the connection between massive macro government debt and the actual borrowing costs you deal with every single day. So let's explore how these giant numbers actually end up hitting your wallet. Okay, let's dive into this. Our source material today, a really detailed CPA analysis, kicks things off with a totally staggering starting point: $39 trillion. To put that national debt into perspective, I mean, if you spent $1 million a day since the birth of Christ, you still wouldn't even be close to $1 trillion, let alone 39. It's absolutely massive, and it's the foundation of everything we're talking about today. But here's the thing, the real gravitational pull on the economy, it actually comes from this next figure. $1 trillion. The analysis points out that the government is now paying $1 trillion annually just in interest to maintain that massive debt. That payment doesn't just exist in a vacuum, It operates like this impending heavy weight that lands forcefully right on everyday finances. Which brings us to Section 1, the trillion-dollar anchor, the macro problem. The source material actually frames this perfectly. They call it an invisible anchor dragging your mortgage rate higher every single day. Think about that for a second. This debt isn't just some distant headline you read about in the news. The analysis shows it operating as a direct, hidden tax that's literally pulling down on your personal financial reality. Moving on to Section 2, the Treasury connection, funding the deficit. Right, so to understand why this happens, we really have to look at how the government actually funds what the source describes as an addiction to overspending. And it all comes down to treasuries. When outflows exceed revenue, when they spend more than they make, these debt instruments are sold to investors. They're essentially just sovereign IOUs, used to bridge the gap and, well, keep the lights on. Let's head into Section 3, the $11 trillion auction, supply and demand. Now, what's really interesting about this slide is the sheer scale of the borrowing. This is where things get incredibly tense. $11 trillion. The United States literally has to sell that exact massive volume in bonds this year just to stay afloat. The system desperately needs buyers to absorb $11 trillion in debt immediately. And here is the unbending rule of the market. Without enough buyers, what has to happen? Well, interest rates absolutely must rise to attract them. The analysis is crystal clear here. If global investors lose confidence, or honestly, if they just get fatigued by our $39 trillion debt, they aren't gonna lend us money out of the goodness of their hearts, right? They demand higher returns for taking on that risk. That takes us to Section 4, the deficit mortgage link, from government to you. Let's move to and see how this builds. How does this giant global dynamic actually reach your bank account? Well, it's a linear chain reaction. Step 1, the government overspends, which forces them to, Step 2, sell massive amounts of treasuries. Because of that huge supply glut, Step 3 kicks in, investors demand higher rates. And because the broader market is strictly interconnected, that higher yield directly pushes your mortgage rate up in Step 4. The dominoes fall right up to your front door. So the crucial point is that your mortgage is ultimately priced off these bounds, meaning your house inherently becomes more expensive. It's the sovereign debt hook. Regardless of what the Federal Reserve wants to do with baseline policy rates, this overarching deficit forces your home loan costs upward. The math simply demands it. And this brilliantly illustrates how the domino effect doesn't just stop at houses. No, it bleeds into almost every consumer product you can think of. Mortgages and home loans for sure, but also your credit cards, your auto loans, even business financing. The analysis shows that interest rates across the board stay elevated because they are all caught up in this broader, high-rate environment created by the national deficit. I love how the source material concludes with this really powerful reminder. It says, the math says the deficit is the trap and your mortgage is the price. The advice here is totally grounded. Don't be fooled by economic theater or all the political noise out there. The underlying reality is driven by undeniable, cold, hard mathematics. Which leaves us with one incredibly vital question. How will you navigate the math of this hidden tax environment to protect your wealth? Understanding these massive economic forces, that is your absolute first step to keeping the math in your favor. Thank you so much for joining me for this explainer, and we will see you next time.